Good afternoon, everyone, and thank you all for joining the Market Performance and Planning Forum. This is Christina Osborne with ISS Stakeholder Affairs. I will be facilitating the meeting. The objective of this forum is really to enable dialogue on implementation planning and market performance issues. So we will highlight key market performance topics, share updates on the 2021 release planning efforts based on input received from stakeholders. We'll provide updates on current and upcoming policy initiatives to help with budget and resource planning. For the implementation planning update, we'll review timelines, discuss external impacts of the implementation plan, and share other key information related to this process. And I just want to note that any discussions related to policy should occur in the initiative stakeholder process. Go ahead and go to the agenda. So first up, we have for market policy and performance, we have Guillermo Batista Alderete, Rahul Kalskar, and Amber Motley, who will provide the market performance update. Also on the line from that group is Abhishek Kundawali and also Rebecca Webb. And then the policy update will be presented by Brad Cooper and John Gooden from the Market and Infrastructure Policy Group, who will be joining us later. And finally, Adrian Chiose from the Program and Application Management team will provide the release planning update. We will be pausing for questions throughout the presentation. At that time, the event producer will provide instructions with how to enter the question queue. We are recording this call. We do make the recording available to our stakeholders on our website. So once we receive that file, we will post it for a limited time on the user group and recurring meetings webpage. You can find that by going to Stay Informed and selecting meetings and events from the drop-down. So with that, I'm going to go ahead and turn it over to Guillermo.
Thank you, Christina. Good afternoon, everybody. Thank you for taking the time for this call. As you know, we have these calls now every quarter, just to give you an update of what's going on with the market. And for this specific call, I think we have a few items. Can we move to the next slide, please? The material is organized in two parts. The first one is the items that may be of interest for the current days, going through the gas conditions that we experienced in mid-February, an update on congestion and revenue rights. We introduced some metrics related to the cost in the CAISO markets, mainly because of the interest that this had on the costs that accrue on the summer timeline. We will provide an update on batteries, on the resource efficiency test, and also on the load conformance limiter enhancement, because you may recall that we have reached the 2-year mark, and we were expecting to assess the conditions that would lead us to disable the limiter if the conditions are met. And then the second part is going to have the standard metrics, and I do not expect that we're going to go through these standard metrics. It's more for your information. These are standard indices and trends that we show in every MPPF. So I would really like to spend most of the time on the hot topics so that we can have some meaningful discussion. So with that in mind, let's move to the first item. You know, all the activity that we experienced in mid-February, prices started to go very high, and they started to ramp around February 11, February 12. And given the gas prices that we observe in the hubs in Southern California, specifically in SoCal and Kern River, we were already in plans to deploy what we call the CCDB functionality, the cost and the whole energy bit functionality. The plan was to implement that by the end of the month. So when we start seeing these gas conditions deteriorating, we expedited as much as we could to deploy that functionality and give this extra tool for participants to use and be able to reflect as much as they could the cost observed for gas conditions. Effectively, the CCDB came in place for trading date February 16, and right after the CAISO CICA relief, effective to be on February 17, such that we were allowed to go through the after-the-fact process for fuel cost recovery when there are bids above $1,000. As we will discuss later today, you are going to see that there were some days in which the given the gas prices, the incremental bids were way above the bid cap of $1,000. And that was the motivation to seek this relief. Now, the first part that was implemented was basically the after-the-fact cost recovery. We are still with a plan to go and implement the full PERC 831 no later than March 21st, that is in a couple of weeks or so. And with this functionality, the expectation is to have effectively the bid cap of $2,000 in place all the time. You may recall through the previous efforts and discussions that we had about the PERC 831 order, CAISO was pursuing some market enhancements through a policy initiative. That initiative, I believe, was called Bidding Parameters and Import Bid Verification. That was market enhancements that could be a good companion to the implementation of PERC 831. With the gas conditions experienced in mid-February, obviously, that changed the perception and the priority that we defined for these efforts. The market enhancements, the bidding parameters, and the import bid verification was actually filed last week, and we're still with the plans to implement this somewhere in the summer. I think the timeline may be around June. But the plain PERC 831 is expected to be no later than March 21st. Now, this is just process-wise what we have been doing in the last couple of weeks when we observe the gas prices going quite volatile in the market. Next slide, please. Let me go now a little bit more on what happened on the mid-February days. And obviously, you can see that we have very high prices, gas prices, mainly in the hubs located in the southern part of the system. The SoCal, City Gate, the Kern River, the El Paso, the main line. These hubs observe prices as high as $140, and these are the day-ahead prices or the real-time prices that we observe in the market. Indeed, when you look at the trading that was happening in the real time of the next day in the gas side, we could have seen trades going way higher than what we observed for the day ahead and the real-time market. And that lasted from effectively February 13 through February 17. And you may recall we have a long weekend, and that's typically just extension of using the weekend package. That is the reason you may see just a flat profile for the gas prices. After that, the prices really collapsed and came back to the range of $3. This period of February 13 through the 17th is really what posed the crazy conditions that we observe in the gas market. And obviously, because we still have a meaningful fleet of gas resources in the system, that transpires into some outcomes of the electrical market. Next slide, please. You may know that we have this manual process in which we use the weighted average price that we have for gas in different hubs in the system by 8:30. And we also see the trading that may be happening through at least one application that we have on our end. And this is what the trading looked like for these typical days, just starting to ramp up on February 11, going through the 12th, and then going very high for the weekend package. And when we came on February 11, the prices were in the range of $5. They were starting to show already an increase because typical prices before were in the range of $3. Then by February 12th, the prices jumped to about $12. And then the weekend package, when we observed trading happening even as high as $200 per MMBTU. The blue dot really stands for the different trades that happen for the day-ahead market, for the next day gas prices. The dot in green stands for the average price that we use specifically on those days. And you can see in some cases like the weekend package, the average price that we had by the time we have to basically grab manually that index and use it in the market was still not reflecting all the activity that was happening that morning. And obviously, this volatility implies a lot of exposure for generators based on gas fire resources because there is a need to be able to recover all their costs. And this is really what precipitated the deployment of the CCW functionality. Next slide, please. One area that we typically don't highlight too much, but it's also one area that we check continuously is the liquidity. And there are some expectations about the liquidity of the hubs that we use for reference on the gas prices, the Curl River, the PG&E, the Scarcity gates. And there are some expectations in terms of number of trades and volume that has to be traded to consider that there is liquidity in those locations. For this specific days, you can see that the number of trades, the volume traded, were still above what the thresholds are for liquidity. So it was not really much of a concern about the liquidity, but it was just about the exposure of these high prices. And in these two plots, you can see the two trends. The first one on the top is the number of trades, and the lower part is the volume of gas being transacted through the different hubs. And there was at least one point of relief because there is always a concern if the trading happening on those locations are liquid enough to have the confidence that they are reflective of market conditions. Next slide, please. With these gas prices, the consequences are naturally reflected in the energy market. We have 40% plus of generation based on gas, and naturally, in some cases, they are going to be the marginal resources. And on these days, we could see that the trending of electrical prices were somehow aligning with the increasing trend of the gas prices. In this case, you have here the day-ahead energy component prices, the LMP prices, organized by the different labs areas in the system, the PG&E, the SCE, and the San Diego labs. There was little price separation among these areas. You can see that the lines overlap quite closely over the different days. There was just some small price separation on February 17th. And most of the time, they were tracking very closely. And the other aspect, obviously, is the level of the prices that were observed for those days. It was until February 17th when the prices reached the $1,000 mark. And after that, again, similar to what happened with the gas conditions, the energy prices started to collapse and came back to the normal ranges that we observed for this time of the year. Next slide, please. This is the similar picture, but for the real-time market. It is here where you can see more price separation when we have prices in the north driven by the PG&E DLAP area being lower and separated from prices in the south, in which we have more expensive generation based on the gas. And the story is quite similar. We see this period of time from February 13 through the 17, 18, where really prices jumped much higher. In this case, obviously, the prices are above the $1,000, not the marginal energy component, but the different DLAPs. And obviously, the reason why they can go above the 1,000 is mainly because of the congestion component. And that is really what shows here with the price separation between the blue line and the other ones that are the red and the green. Next slide, please. Before I keep going forward, let me see, Christina, if we have any questions so far.
Sure. So if you do have a question, you can raise your hand by pressing #2.
All right, and I currently have no callers in the question queue.
Okay, thank you. This is another area that we are looking at and has to do, obviously, with the bid that the market had to run for these specific days. This organizes the different volumes of the bids for the supply side in terms of the price range. We may have a range at the bottom that are for self-scalers going for negative bids or for $0 to $50 bids and so on. And then on the top, you have the ones in red that stands for the highest price range bids. These are the bids that may be anywhere above $500, and we organize this in two groups. And the interesting part and the natural consequence of having these extreme gas prices is obviously that the incremental bids are going to be ideally reflecting that. You may recall that we still had the bid cap of $1,000 on those days, and therefore there are no bids above that bid cap. And you can see that there is a meaningful increase of the volume of bids coming at the higher range of prices between $750 and $1,000, and that is totally expected given the price that we have for gas. After that, after February 18, we can see that the volumes start to diminish, not as much as the days before this cold spell, but they are still way lower than what we observed in the middle of February. Next slide, please. This is a more targeted view of one specific hour. We pick basically the peak hour of each day. And just to make this less crowded, we broke it down in two groups, one for the first 7 days, the second one for the second 7 days. Just to give you a sense of how the bid stack for the peak hour is composed. And if we start from the lower left, we can see that there are 3 lines where you have the typical profile, right? We have a self-scale range going through the zero, then it stays in a plateau of very low range prices, less than $200, and then you have the joystick that just goes vertically all the way up to $1,000. That is kind of typical bid stack that we observe from day to day. The natural second set of plots that you have in the same lower left illustration, they are all gathered pretty close to a small range of prices because they just go vertically very fast. And at the top, they are just sitting at $1,000. That is the bid cap. So there is much less volume of bids in lower price ranges because they go all the way to $1,000, even though the volume may not be that different with respect to the previous days. And for the second set of days, from February 17th through the 23rd, you could still see some lingering effect of that price bid stack, where you can have a couple of days that jump to 1,000 and stay flat at 1,000. The subsequent days may show that they are coming back to normal, where we have extended bid stacks at lower price ranges, and only up to the top when we experience the cap of the $1,000 is when you have this portion of a flat segment just sitting close to the $1,000 price. Next slide, please. On the demand side, naturally the participants can also bid in the day-ahead market for demand. We don't see such a dramatic difference for the bidding demand, even though the conditions were dramatically different for the supply side. Next slide. This one is just an illustration. We picked a couple of days, one before the high gas price conditions and one in the middle of the gas price conditions, just to see the composition of the bid stack. It's still one of the peak hours. And if you focus on the left-hand side and plot, you have February 11, where prices were in the range of $10, $12 per MMBTU. And you can see this nice flat line in the lower price range. And it's a mix. We have all types of supply, imports, internal generation, and convergence bids for supply, or DG, that is the conversion generation. And not surprisingly, all the internal generation is sitting in the lower range of prices, anywhere below, I would say, $100. The vertical section of that bid is mainly composed by convergence bids. When we look at the same structure for February 14, one of the days with the high gas prices, you can see some interesting shift. Obviously, we have bits related to internal generation or conventional generation that are going to be sitting at the bid cap of $1,000. And you can see that color-coded in red for internal generation. There is still some meaningful amount of imports still sitting at $1,000, and then there is a little range of the economical bids below $100. So you have this very vertical trend going straight to the $1,000. Next slide, please. What are the consequences of having these high gas prices? In addition to having bids reflecting those prices, the market solution is going to reflect the economics that we have based on the structure of the bids. High gas-based resources bids are going to naturally be economically displaced by cheaper generation from any type of technology, namely renewable resources, imports, hydro, or even gas-based resources from the northern part of the system, because even though the south experiences these high prices, the north, the PG&E Citygate hub price for gas didn't observe such dramatic increases. So naturally, there will be an economical displacement of cheaper generation from the northern part of the system for the southern part of the system. And this is really what is reflected here. The composition of this bid stack is based on the different hubs that we use in the CAISO system resources. There are different resources that are plugged to different pipelines, whether it's related to the Curl River, to the SoCal system, or the PG&E. And there may be others that are in El Paso or Mainline, or indeed there may be some gas resources that do not have neither of those specific hubs, but they use a generic hub for gas that happens to be the minimum of these three ones. And you can see that for the period of February 13 through, again, February 17, 18, the generation dispatch in the south for gas-based resources was at minimum. You can see very small quantities of generation based on gas being dispatched on those days, as expected, because they are the most expensive ones in the system. And naturally, that is going to be feeding by cheaper generation from PG&E area. And that is just expected given the economics that we have for this day, for that period of days. Next slide, Christina. And that has a consequence in terms of how much gas the power system is burning from the different systems in the gas side. This trend just shows you the total volume of gas burned per area. Basically, the SoCal gas system, the Curl River system, or the PG&E system. And actually, again, on these days of February 12, 13 through the 17, 18, the total gas burn in the southern part of the system was at minimum. Naturally, again, the PG&E was filling in for that space. Next slide, Christina. How is the composition of the generation for those days? We know that there are some resources like nuclear or geothermal that are base and flat sitting all this time. And there is other type of generation like the solar that is going to come at specific hours of the day and is going to fill in the midday. Naturally, that solar is going to displace either gas generation or imports. That is what we have seen historically. And this just tells you the overall composition of the generation mix that we have. Naturally, the decrease of gas generation in the south was picked up by generation in the north, by other gas-based generation, and by the other types of conventional generation, including the imports, the wind, the solar. And keep in mind, I think we got a couple of questions in recent past regarding this condition. And the question was in regards to why, if we have such a price separation for gas between the north and the south, why we don't see this pronounced, persistent congestion going from north to south, such that we are moving and displacing economically all the generation in the south by generation in the north. But keep in mind, the time of the year, right? We are dealing with a system load that is in the range of 26,000 megawatts. If this were going to happen when we have higher demand, naturally it's going to put more pressure on the backbone of the transmission system, and we may be exhausting all the capability that we have to move power between the north and the south. For these days, given the levels of load that we have, we barely see that happening because we still have generation in the south, not gas, but we have other type of generation in the south. So the dynamic was there. The conditions were such that there was not such a steep or persistent congestion in the backbone when the displacement of generation happened from the north to the south. Next slide, please. Regarding imports, how the imports and the exports generally behave on those days, I would say it was relatively quiet. Yeah, there may be some small trend here where the imports reduce a little bit. Naturally, we may have some behavior that comes with the weekends, and exports marginally increased during those days, but nothing to be completely out of the ordinary. And this one just shows you the volumes of bits that we have for imports and exports and how much of that we were clearing for those specific days. Next slide, please. That one is going to show the movement from the day ahead to the real time. It's not dramatically different. Obviously, we cleared some levels of net imports in the day ahead market. When we came into the real-time market, we have more exports. Effectively, that means our net imports are lower for some days, but still nothing completely out of the ordinary given the extreme conditions that we have for the gas system. And there is one other angle that we were looking at, and naturally has to do with the implications of having or not having the CCDB in place for those days. And I think by the time we implemented CCDB, it was kind of a bit late because it took effect until the 16th. And you could see that the highest prices that we have seen were just prior to those days. And what we have done to get a sense of the implications of the incremental bits, given those high gas prices, is a very simple exercise. We don't know exactly what the bid should have been if the bid cap of $1,000 was not in place, and whether we would have already the $2,000 bid cap in place. So what we have done is just to recalculate the default energy bids without any bid cap. Even the default energy bids, when we have the bid cap of 1,000, are capped to that level. So if we just go and rerun the default energy bits naturally with the gas price that we see in our system without imposing the bid cap of $1,000, what we are going to get is the darker part of this plot. If you look at, there are two colors. One in gray, that is the original default energy bits that we have that are capped to the $1,000 per megawatt hour. On days of February 10, 11, there was no need to reach the levels of the bid cap. You can see that the default energy bids were no higher than $300. As we move, let's say, to February 13, you can see that there is a little portion here that the original default energy bids were capped at 1,000. Once we recalculate the default energy bids with the natural gas prices and no bid cap of 1,000, you can see that naturally the default energy bids can go as high as $1,600, $1,700. And if you look at now for the real time of February 13, here we actually have a more pronounced pattern. And in this case, again, the light gray stands for the original default energy bids. The darker portion on top stands for the additional cost that the default energy bids reflect if we don't have the bid cap of $1,000. Naturally, we would expect that the incremental bids that would have come for the market could have been reflecting this high cost. And you can see that the cost is indeed exceeding the $2,000 reference mark. And this, again, was before we have the FERC 831, therefore we still impose the bid cap of $1,000. Once we start going through the days of February 18, 19, you can see that the price start to come back to normal, and naturally there is less incremental bids that could be above the $1,000 bid cap. And this is just to illustrate that, yes, given the gas prices that the market used, even at that level, there would have been incremental bids above the $1,000 bid cap. Okay, let me pause to see if we have any questions.
Yes, great. So we do have one person in the queue. Again, if you have a question, press pound 2 to raise your hand. So Chris will take the first question.
All right, moving on to our first caller in queue. All right, caller, your line is now unmuted.
Hey, Guillermo. Dan Williams from Customized Energy Solutions. First, just thank you for the excellent presentation from you and I'm guessing your team that helped put a lot of this data together. It's very helpful and very timely. I'm just curious if you have any takeaways you can share from the market performance in the EIM areas, especially in the desert Southwest. Kind of thinking about what sort of transfers the CAISO showed during these days, and then how the FRP and the market in general performed on, specifically probably on like the 16th, 17th, 18th. Because I expect that the imports that you were showing on the earlier slides were half imports, not EIM. I'm just curious if you have any thoughts on those, even though you didn't have any slides on them.
Yeah, unfortunately we ran out of time to bring the information related to the EIM. You are right, the information we are presenting today regarding the imports and exports is purely the intertie transactions. From the CAISO point of view, it doesn't include any type of EIM transfers. So I don't have the material, and I wish we could have that so that we could elaborate. So I will consider that to see if we can release later some information through other means, maybe through the big weekly update call, just to provide that transparency. But at this point, I didn't really have material to present.
Okay, no problem. And thank you again. It's really, really good material we put together here.
Thank you.
All right, we're on to our next caller.
Okay, thanks, Chris. Go ahead.
All right, caller, your line is now unmuted.
Hi, Guillermo. It's Callie Wells with WPTF. First of all, echo Dan's comment. Really appreciate you guys pulling this data together in such a short amount of time. So these metrics you have on slide 22 here are very interesting, and I was curious. I know this is focused in on the default energy bids for those incremental energy offers. I was curious if you guys did something similar on the commitment cost, because when CCW was deployed on the 16th, if I remember that date correctly, that impacted the startup and then load cost bids. So I was curious if you guys ran some numbers to see kind of how limiting the 125% bid cap kind of restricted the ability for market participants to reflect the actual cost prior to the CCW deployment.
Yeah, this is another set of information, Kelly, that we ran out of time to be able to put together. I think we will need to find another opportunity to show that information. Yes, you're right. I think once CCW is in place, we want to see how that play out before and after the implementation, because obviously the incremental bits are important, but equally important are the coupling costs, the minimum load costs, the startup costs, and even the default energy bits that we have. And from the experience that we have once we implemented the CCW, I can tell you, I don't have numbers to show you, but I can tell you that it was utilized through either the automated process in which participants have control on what to adjust for, or through the manual request, and some of them were accepted, some of them were not, given the conditions that we imposed to have the manual request. I will find out how we can put these metrics out there for the public.
Okay, I really appreciate that. And if, when you guys have that data available and out there, if there are any potential lessons learned in terms of using the automated or manual reference level requests that maybe market participants can take back so that the next time, gas prices go volatile, if there's anything they can do on their end to kind of help ease that process, I think that would be really useful information as well.
Oh, yeah, and that's a very good point, Kelly, because obviously, given how fast we have to deploy this to try to make it available for participants, it came basically too quickly, right? And we naturally expect that is going to create some anxiety and confusion and anxiety in participants of not knowing exactly how to use it in some cases. We understand that we created that short window and that comes with some consequences. I think overall it was the approach was to make sure that we have the available tool as soon as possible, and yes, it takes some learning curve for participants to get comfortable and realize what mechanisms and how they can leverage on those tools. We try to close the gap, and obviously that was after we passed this wave, by providing more ad hoc training for the participants so that they know exactly where to go, what to do, what leverage they have on the functionality. And we have also received some feedback about the limitations that we currently have with the policy that we put in place. And I think we are collecting all that and see if we can come with a more general message and see how we can improve within the scope of the current implementation that we have, or if we are just finding that there may be some limitations that we may have to consider for further enhancements.
Okay, yeah, really appreciate it. Thank you.
You're welcome.
Chris, do we have anybody else in queue?
Yeah, we do have one more caller in queue.
Okay.
All right, caller, your line is now unmuted.
Yes, hi, Guillermo. This is Michael Rosenberg with M3, and I have a question about a few slides back you showed the separation between different zones and day ahead in real time. And in particular, I have a question about this constraint 6410 that separated north and south. And it shows a strikingly different behavior in day ahead in real time. And I'll just pick one date, 17th of February. So it congested very, very heavily over the entire evening peak from hour end 17 through 24 in real time, mostly with shadow prices at around $1,000 or above $1,000. Now, if you look at day ahead, it shows very puzzling behavior. It shows up in hour 17 with some small price, and then it's zero between hours 18 and 21, then shows up again in 22, and in hours 23 and 24 goes to $700 plus close to $800 shadow price. How do you explain such a striking difference in day ahead in real time? It seems like something is done to eliminate congestion between the hours where it's most heavily congested in real time. Something is done to eliminate this congestion in day ahead. What is that?
Yeah, well, let me to recharacterize your statement, because I don't think there is an intent, implicit or explicit, to eliminate the congestion. Let me just be clear on that. I think we need to understand the nuances of dealing with the day-ahead market that is a forward market, a financial market, against the real-time market that is more operational driven. And yes, you're right, there is more pronounced differentiation between the day-ahead and the real-time. The day-ahead shows little congestion, the real-time shows more heavy congestion. There are naturally differences between day-ahead and real-time, right? Convergence on its own is going to potentially shift that part one way or the other. Now, the reality is that once we go into the real time, we are dealing now with an operational condition. We are really dealing with managing the system. And I can tell you that for those days, the operators have to handle that constraint in the real-time market to align with the conditions that they were observing in the real time. Effectively, they were adjusting for operational or reliability margin. and that means it was more restrictive in the real time. Now,
okay, that answers partly the question that it was the different limits control they had in real time, right?
Yes.
Yes.
But that is my
question. Sorry, please continue.
Yeah. Let me just finish the thought process here. So the point I want to make here is that we need to realize the timing, right? We are dealing now with the real time. And this is happening as we speak, right? It's just in time. The day-ahead market was run basically 15 hours ago. When the conditions happen in the real time, the day-ahead is already behind you. There was no way for that specific day to internalize whatever the operational conditions were observed for in the real time. The soonest opportunity we may have is potentially next day for the subsequent trade day. So I think I want to highlight that because typically people forget that, yeah, it's a day-ahead versus real-time market, but the day-ahead market will run many hours in advance to the real-time conditions. So when you experience the conditions in the real time, again, the day-ahead market is already behind you.
Well, I agree with everything you said, but the fact, again, I don't have gas prices handy, but I presume in day ahead there was a substantial separation between gas price in the north and gas price at SoCal. And thus, what is puzzling is the total absence of this congestion between this congestion, 6410 north to south, between hours 18 and 21 over the evening peak in day ahead, and very heavy congestion at real time. It suggests that the physical limits must have been very different, or the limits with which the network was solved must have been very different. Otherwise, I'm really puzzled about such striking difference because the fundamentals were about the same in day ahead in real time for gas prices. Back to you.
Yes, thank you. Point taken.
Any other questions in the queue?
I have no more callers in the question queue.
Okay. So let me change topics now. This is a quick update about 2-3 items that we historically track, and this one pertains to congestion revenue rights. I will cover 3-4 slides just to give you a snapshot of how the CRR market is performing these days. I know it was an important topic a year ago or so. Now we are just seeing the performance over time. And there are different metrics that we have shown, and we just continue to update those. One of them is obviously the volume, the level of activity related to revenue rights. And in this one, obviously, we have the balancing account numbers, how much CRRs are at face value, the notional value, how much CRR deficit we have to spread across the pro rata allocation process, what is the final CRR payments or value of the CRRs that we have in yellow, and how much surplus we collect on certain constraints. You may recall we do this by constraint. And then the last metric is how much revenue goes effectively to measure demand. And that is the surplus that naturally arises from the congestion revenue right settlements, plus the auction revenues from both the annual and the monthly processes. And the conditions in the summer were obviously quite high. Naturally, congestion was equally high. As we come out of the summer, you can see that things start to get stable in a much lower level, and that continues as early 2021. Next slide, please. This one is a metric that we introduced about a year ago and has to do with the activity of CRRs that are being allocated to load-serving entities, and later on they are sold in the auctions. And this is a specific item that we identified in the past to be a contributor to the revenue, to the auction inefficiency that has been a theme of CRRs for the last 2-3 years. And in this case, we illustrate the volume of allocated CRRs by time of use in which they are put for sale and how much of that is actually cleared or sold in the auctions. And you can see that generally speaking, the level of allocated CRRs over the years, even before we implemented this metric, has, relatively speaking, continued to increase. We have volumes as low as 1,000 megawatts in early 2017. As of now, we are talking about over 3,000 megawatts of allocated CRRs being sold in the auctions for on-peak. And the portion of CRRs that is not cleared, you can see is relatively small, meaning that selling CRRs from the allocation process seems to be highly successful. And when a participant is coming forward to sell a CRR, obviously has to express the willingness to sell that CRR at a strike price. So they control how expensive that CRR is going to be for potential buyers. And one natural intuition here about the high level of clearing CRRs being allocated and then sold in the auctions is that they may be sold relatively cheap, such that they can achieve such level of clearing success. And we're talking about, in general, they clear about 90% of the time or 90% of the volume that is put for sale. So that may be just an indication of the willingness to sell those CRRs. And obviously, one complication is that these are financial instruments that have to be assessed based on expected conditions of congestion. There is no guarantee that that condition is going to materialize, and therefore there is an expected risk that has to be built in the bid. And we can know what the actual value is only after we have settled the day-ahead market. Next slide, please. This is just the volumes. You can see that generally speaking, the volumes of auction revenues remain relatively stable, and there are up and down depending on the month, on the season, but relatively speaking, they are within the historical range, so nothing out of the ordinary in this case. Next slide, please. This one is one of the key metrics that we use based on the intent of the policy initiative that we have, that was to achieve revenue neutrality or to attain revenue adequacy, meaning the funds that we collect from settling the day-ahead market could be enough to pay for the CRRs. And this just makes a comparison. We get a counterfactual calculation in the case we didn't have the pro rata funding in place. That is reflected with the bars in green. And then the actual ones that we currently have now with the pro rata funding are reflected with the bars in blue. And you can see that persistently the pro rata funding is going to reduce the CRR payments to the point where we can achieve neutrality, and that means that now there is more chances of getting the revenue adequacy right. And at the end, that is money that goes to measure demand, because now they come forward with a balanced starting point, because that is the whole point of having the pro rata funding, to start with revenue neutrality. And therefore, any surplus, any additional money from auction revenues are going directly to measure demand. Next slide, please. This last one is about the auction efficiency. How much money is paid to acquire a CRR versus how much money is paid to the holder of that CRR. And we have discussed this so many times about the implications of this metric. And we provide this update in every NPPF that we have had for the last 2-3 years. And just to give you a status where we are, and obviously every month is going to be slightly different just because of the dynamics of the market. Level of congestion changes from month to month, conditions changes from month to month, and therefore this metric is going to be quite volatile, I would say, in some cases. in the summertime, we have a lot of congestion. The auction efficiency was relatively low as 23, 24%. In the recent months, with milder congestion, not so much surprises in terms of outages and so on, the auction efficiency metric is actually pretty good. It's over 100%. And you can see that the bars in blue and red are quite close one to another, and that's a very good indication how good the convergence is between the CRR auction and the day-ahead market in terms of the congestion and CRR payments. Okay, let me pause, Christina, and see if you have any questions related to this topic.
Sure. To raise your hand, press #2. Chris, let me know if anybody enters the queue.
All right, I do have one caller in the queue. All right, caller, your line is now unmuted.
Hey, Guillermo, this is Seth with DC Energy. I appreciate the discussion on CRRs. I think it's an important issue to keep a pulse on. I just had one question about the pro rata funding. What is the CAISO's view on the impacts, the downstream impacts of those partial payments in terms of people's ability to hedge? I would note that there was a recent report put out by LEI Consulting, independent report commissioned by PJM, that showed that the hedging benefits and other benefits exogenous to the CAISO are on the order of 5x in terms of the overall market sphere and how CRs fit into those. And I was wondering if there's been any discussion about that or consideration of that.
Yeah, I think I would be just reacting to what you're saying, because at least I personally haven't seen the report. It would be interesting for me to at least grasp what the point is. And I don't think I need to go in this update of the policy discussion. I think we discussed during the policy initiative the pros and cons, and we took this stand of approaching the pro rata funding. I can understand it may create some additional volatility, uncertainty on the hedging that CRRs may give. But I think as of now, the fact that we implemented the policy is because we believe that is what was the right course of action at that time. I think what we committed to do is to continue to assess the CRR performance to see if there are any other merits to do any other type of enhancements based on the performance that we actually see. And I think I would just comment on that.
Okay, thank you. I appreciate the discussion, Guillermo.
Yeah, and if you don't mind, could you just send me the reference for the material that you pointed out, please?
Yes, I will. Absolutely. I'm happy to do that.
Thank you.
Any other questions, Chris?
I currently have no more callers in the question queue.
Okay.
Okay. Let me change topics now. And the next topic is about the CAISO overall cost. And I think we got a couple of inquiries in the past regarding the cost related to the summer event. And that is the main reason we put this together. I think we may have discussed briefly this in updates in the past, but I wanted to put something out explicitly about the cost that we accrue across the CAISO market. I would like first to define what we mean by cost, and usually the CAISO market cost. And this cost may include the different components that we have given the structure of our market, including the energy settled in the day ahead, in the real time, and the costs associated with providing ancillary services, the Victor recovery, the GMC, and the reliability model resources. And I believe these are the main components of the cost. So next slide, please, Christina. This is just a quarter trend of the overall cost in the CAISO's market. And the natural question was, how much was the cost given the summer conditions in 2020? That would be captured naturally in the bar of Q3 2020. And for that quarter, the costs were about $3.8 billion. naturally you want to do some basic comparison how that compares to previous years, and we can just go back to the last 2 years, right? And we can go even further back, but I think the last 2 years give you just a sense of where that number is. And it was higher by $1.3 billion than in Q3 2019, but it was actually lower than the Q3 of 2018. And that is always more behind why that was the case, right? And you can see that naturally it's going to move around based on the system conditions. Typically in Q1, Q2, you are going to have relatively lower levels. Typically when we have gas conditions like what just happened in February, we observe those in February time frame. So even Q1 sometimes may be coming higher than expected just on seasonal conditions like low levels. And overall, I think for 2019 and 2020, we are talking about annual total cost to be about the same. That was around $8.9, $8.8 billion. And that remains quite about the same between these 2 years. And it's a reflection of all the system conditions evolving year from year. You may recall 2019 may have been relatively a quiet year. 2018 was a very active year given the gas conditions basically in the summer. You go back to 2017, we have these load-breaking records around late August, early September timeframe. So there is always more story to be told as to why these costs are fluctuating that way. Next slide, please. When you compare this on a monthly basis, obviously it's going to be kind of random. You can see the cost going up and down even for the summer time frame. And even the peak, right, is not granted. Sometimes the peak may happen in August. We have observed some peaks actually happening in September. And you can see that these are just very system conditions dependent. And if you look at a monthly basis, you can see, for instance, the costs accrue on August. That generally is going to be the month when we observe the peaking conditions. And yes, August 2020 was higher, almost $2 billion in comparison to about $0.8 billion of 2019, and not that far from the $1.7 billion of 2018. Next slide, please. When you see the composition of the overall cost, all these $8.9 billion that we are talking for 2020, you can see that naturally the day-ahead market is the one that commands the majority of the cost. Over 90%, typically it's around 94, 93% of all the costs transacted in the CAISO market are related to the day-ahead market. And obviously, this is the main market because that is where the largest volume of transactions happen, right? When we go from the day ahead into the real time, we are really talking about the imbalances. That is one of the reasons we call the imbalanced energy market in the real time, because it's just to true up the differences with respect to the day ahead. Naturally, there will be a very small cost component just for the imbalances in the real time. Next slide, please. And the cost is, it has two main inputs. Obviously, one is the price, how expensive the price was, not just the energy, but also the congestion and so on. But the other side is also the energy that is transacted, right? And not just the peak level, but in total, the energy settled across the whole time. When you compare, for instance, the last 3 years, 2018 through 2020, you can see that the costs are relatively in the same range. The energy transacted, that is the trend in orange, is not that different from year to year. And these two components together is going to show you that overall the costs are within the relatively narrow range of dollars. Next slide, please. If we convert this, trying to take out the component of the energy, how much energy was transacted, and just bring a reference in the same baseline that would be dollars per megawatt hour. effectively you just divide the total cost by the total energy transacted, and you can get this average cost of dollar per megawatt hour. August 2020 was, I would say, the highest of the last 3 years, but not that far high from the one experienced in July 2018. We're talking about $87 per megawatt hour for the month of August, given the high prices that we have, given the limited supply that we have. Next slide. If you see in a more granular basis, this would be on a daily basis, and this just captures snapshots of the summer conditions. And you have summer for 2018, 19, and 20. And you can see how mild 2019 was. You can see how extended 2018 was, given all the gas conditions that we have. And you can see how spiking 2020 was, because there are fewer days, but with much higher cost. In one single day, I believe it was August 17, is when we reach a total cost of about $370 million, and that will be just one day. Right? So you can see it's more compacted in a fewer days than 2018 at a higher levels. And that speaks a lot to how different year to year you can have this to try to make a simple comparison of just looking at 2020 versus immediately what happened in 2019. So I think the point here is that we need to put in perspective many other variations and components that play a role in determining the overall cost. And I think that's what I have for this portion. Can you go to the next slide, Christina? Okay, there is one more. And this is just a simple correlation. You may recall in 2018 we have some gas activity when we have high gas prices for sustained periods of time, and this just correlates the cost of the overall CAISO market against the trend of the gas prices. And there is some level of correlation as you expect, because again, the marginal pricing that we have in the market in some cases is going to be set by gas resources, and obviously gas resources are always a meaningful portion of the generation mix that we have, and therefore they are going to drive certain cost. So it's quite expected to see this type of correlation between gas prices and the overall cost in the CAISO market. Okay, let me pause to see if we have any questions before we move to the next topic.
Sure. So Chris, do we have anybody currently in the queue? Again, press #2 to raise your hand.
Currently have no callers in the question queue.
Okay, then I think we can move to the next topic, Christina, and I will pass it to Rahul.
Thank you, Guillermo. If someone can confirm, you can hear me?
Yep, we can hear you. Thank you.
Okay, thank you, Christina. So I will cover a few slides for storage resources, and to give everyone some background, starting with the last MPPF meeting, we have started providing some metrics for storage resource performance. So what you're going to see here in the next couple of slides is a comparison of the storage dispatch in the energy market, and also some chart for the ancillary service. And I was still looking into, what's the best way to capture this information. So these slides will continue to evolve as we try to find the best way to represent what's happening with the storage resources and how they are participating in the market. With that, let me start with this slide. What this slide is capturing is the dispatch for energy in the day-ahead market, or especially the IFM market for storage resource. And we have been observing this trend for a while now, that the storage resources tend to charge during the hours with the least price. And for the most recent months, the price has been relatively lower during the solar hours in the afternoon, and we also see some lower price in the early morning hours. So those are the time frames when the storage resources are charging and then they tend to discharge with the highest price. And as we know, the impact of the duck curve, the hours right after the evening peak, which is the net load peak when the sun is going down, tends to be the hours with the highest price. So we observe that the resources are discharging during the highest price hours. And this trend has been consistent across most of the months. And the volume of charge or discharge actually is driven by two aspects. One, we are getting more storage resources on the grid gradually. So the pool of resources that are available to the day-ahead market also is changing. And the second aspect we have observed is the storage resources have a specific preference when they want to participate only for energy, and there are other days or hours where they prefer to operate for both energy and ancillary services. So naturally, if some of the capacity is being used for ancillary service, the total volume for discharge in energy around the peak could also go down. So those are the primary drivers that we see for change in the volume month to month. And Christina, can we go to the next slide? Okay. This chart is similar to what we observed in the what we had in the prior chart. The prior chart had the energy award in the IFM. This chart essentially represents the energy award in real time. And there is a marked difference between the day-ahead and real time. And at the first glance, it appears really unusual. But if you pay a close attention to the dynamics that go on between day-ahead and real time, this chart tends to make more sense. What we observed in real-time market is there is a lot more volatility in terms of pricing because the imbalance requirements can be very different from day to day. And it is possible that some of the storage resource may charge or discharge not necessarily in the evening peak or the afternoon time frame. The pattern can change depending on various reasons. For example, if storage resources are providing ancillary service and when they're on AGC, they end up using all of their stored energy, then they would be basically charging in the real-time market, and that would be one reason to see a difference from the day ahead. And other reasons are obviously, in a real-time market, you may have more volatility on other type of resources that may drive the demand from storage. So those are some of the reasons you see a difference between day ahead and real time. But in general, you may see there is a general trend of to charge in the early morning and the afternoon hours and then discharge in the evening hours. But you may not see the exact same pattern between day ahead and real time. Can we go to the next slide, please? Okay. This is a slide that we are still trying to figure out, what's the best way to represent ancillary service volume for storage resources across months. Some of the key observation that you may see from this chart is starting in November timeframe, you see a much higher volume in AS compared to September and October, and that's basically driven by a change in pattern of using storage resource for energy or AS. And then in the most recent month, you can see between December and January timeframe, we see a much higher volume of regulation down being procured from storage resources in January than compared to December. And the reason for this is twofold. When you go to January timeframe, we are seeing a slight increase in the solar output, and then we are also seeing a much higher regulation requirement and certain storage resources have started participating more with the regulation. So those are the key reasons that is driving this trend. So let me pause here, Christina, and see if there are any questions.
Sure. So do we have anybody in the queue, Chris?
Yeah, we just got a caller who just joined in on the queue. All right, caller, your line is now unmuted.
Hey, Rahul, it's Callie Wells with WPTF. Quick question on this slide that you have right here, the all of a sudden change in November where the resources are providing more AS. It looks like it's a pretty significant jump in spinning reserves. Just curious if you can provide any insights you have. Is that just a change in, are they now bidding in to offer spin, or is it actually they're offering in to provide reg, but they're being awarded, but it's helping meet the spin requirement?
That's a good question. So there's two aspects. I think first is we do see some participants making a switch between participating only in energy to then started submitting bids for ancillary service. And the second aspect that you mentioned, I think the cascading that you are referring to using regulation for spin, not necessarily that driving the spin price being substituted for non-spin. Because generally we see a much higher price for regulation than spin and then higher for spin than non-spin. So I would attribute to a change in market participation.
Okay, so you're saying they're actually bidding in more to provide spin than they were in prior months.
Yeah.
Okay. Interesting. Okay, thanks. That's all I had.
Okay.
Thanks, Tom. Any other questions?
I currently have no more callers in the question queue.
Okay. Can you go to the next slide, Christina? So this is a slide, staying on the same topic for storage resource, but we wanted to have this discussion here about an upcoming change to our current implementation of how the real-time market manages the state of charge. The ISO has recently filed a Bpm change, and this Bpm change is mainly related to how the real-time market manages the state of charge when the resource has a regulation award. So basically in the current implementation, when a resource has a regulation award, in the real-time market, rather in the 5-minute market, we reserve enough state of charge for the resource to deliver 5 minutes of continuous energy. And moving forward, we are proposing a change. We want to reserve, ensure that the resource has enough state of charge to deliver the regulation for continuously for 30 minutes. And this change is mainly driven by what we have observed in real time by our operators. And what they notice is for those storage resources that have a regulation award, at some point of time they were running out of state of charge and could no longer support their regulation award. And when we started looking at the behavior, we saw that the state of charge was only enough to support 5 minutes of delivering continuous energy. So we believe this change of moving to reserving 30 minutes of regulation would really help in terms of operations and to manage AGC. Krishna, can we go to the next slide? So this is a simple example of exactly what the change I was referring to in the prior slide. For example, if there is a resource that had 100 megawatt of a regulation award for the 15-minute, for a single 15-minute interval, then based on the current rule, the market will ensure that the state of charge for the storage resource does not fall below 8.33 megawatt hours. Now, moving forward, we are going to ensure that the state of charge for the resource does not fall below 50 megawatt hours. And essentially, you can see the way we are calculating in the current market is we are only reserving for 5 minutes of SOC equivalent to the regulation award, whereas what we are proposing now is to ensure that we have 30 minutes of SOC to support that regulation award. So, Christina, can we see if there are any questions about these two slides?
Sure. I think we have one caller in the queue. And again, just a reminder to press pound 2 to raise your hand.
Yeah, we do have a couple callers in the queue. Moving on to our first caller. All right, caller, your line is now unmuted.
Hello, this is Alvis Svoboda from PG&E. I just wanted to ask a couple of questions about this state of charge management. Is this a change in the operations? I can't remember. Did you say it's in the BPM? Well, the previous slide.
Most recent BPM change. I think we filed something last week or early this week.
Great, thank you. So, will this implementation include then? Would you be buying back spin or regulation if in particular regulation if it was not if you did not have sufficient in real time you were seeing that you didn't have sufficient reserve to meet a regulation award, and which could be potentially because of CAISO regulation of the resource in previous hours?
So I think what you are going to observe is market is going to try to charge the resource rather than do a buyback.
So you would charge, but you'd preserve the award?
Yes. Because the change that I'm specifically referring to is in the 5-minute market. In the 5-minute market, we already have received the AS award, so there is no buyback in the 5-minute market.
So basically, you would just see the regulation. Effectively, it wouldn't be used, but you'd be charging to try to get to that point where you could again use it.
Yes.
Okay. And then just to double check, would be a similar constraint in the reg down direction?
Yes. Yeah, this example here is just to simplify and explain exactly what the change, the details are there in the BPM.
Okay, great. Thank you very much.
Sure.
We'll go to the next question.
All right, moving on to our next caller. All right, caller, your line is now unmuted.
Hi, it's Callie Wells with WPTF again. Couple questions here. So is this the BPM change that was referenced in the summer readiness proposal?
So in the summer readiness proposal, I believe there were some changes that were referred to the AGC management and regulation. That's what this BPM change is referring to.
Okay. So am I understanding this that you're kind of essentially assuming some sort of deployment rate for resources that are awarded regulation, meaning that you're assuming when a storage resource is awarded regulation, it will be actually used for about 50% of what it was awarded?
No, I don't think that's the change for this. That's what this change is talking about. So when a resource receives a regulation award, the regulation piece is managed by the AGC. So AGC is going to utilize the full range for whatever the amount it's awarded. What this change is talking about is if the market observes that the resource has a regulation award and it sees its current state of charge, and it sees that if the current state of charge cannot support the full regulation award, then the market is going to ensure it's charged or discharged depending on we are talking of regulation up or regulation down.
Okay, so basically if it has this reg up award, you're saying we need to make sure it has at least 50 megawatt hours stored so that if we called on it for 30 minutes all the way for the full 100 megawatts, we know it can sustain that.
Yes.
Okay, super helpful. So when the resource is actually awarded the regulation in the day ahead and incrementally in the 15-minute market, is there any, my understanding is right now the market does not assume any use of that regulation that impacts the state of charge as it calculates it. Is that correct? Or is there something in the market that says, if we're awarding you 100 megawatts of reg up in this hour, we know you'll be used for some of it, so the next hour state of charge will be, reduced by some assumption?
So in the day-ahead market, the market will ensure that there is a state of charge reserve for regulation. So, for example, if a resource gets a regulation award of 100 megawatts, then the market will ensure that 100 megawatts of SOC is reserved for full 60 minutes. Once you come into 5 and 15-minute market, we are just going to ensure that it has enough SOC to support that award.
Yeah, so I get that. I guess my question is, let's say back into the day-ahead market, and if this is better to take offline, more than happy to, I didn't mean to derail the conversation here. But in 1 hour, if it's awarded 100 megawatts of reg up, I know that the market has to make sure, will check to make sure it has enough state of charge to support that. But then the state of charge for the next hour, I know that state of charge is, adjusted for any charging or discharging schedule, but is it also adjusted for any assumed use of the actual reg up?
Yeah, Kelly, I think you have really good questions, especially considering the scenario, what we do for subsequent hour. I think it may be useful if you can send an email with that example, and then we can have that conversation given we have the BPM discussion, and then I'll make sure I post in the slides.
Okay, great. Thank you.
Thank you.
Any other questions, Chris?
All right, I currently have no more callers in the question queue.
Thank you.
Okay.
I think we can go. I think I'll try to cover this briefly, and then we will just move on to the next section. So this next two slides provide the statistics for all the balancing areas that participate in the energy imbalance market, which includes the California ISO. And in the energy imbalance market, the ISO performs 3 tests for each hour. That's the balancing test, capacity test, and the flexible ramp sufficiency test. The flexible ramp sufficiency test is one of the most critical aspects for the real time, because that is what controls an Eim entity's ability to have transfers. So that's why this metric is something that we have been publishing for each of the MPPS meetings. From the chart, the trend has been pretty much the same. We observed that most of the balancing areas have passing all of their up sufficiency tests. The failure rate for some that do observe a flex ramp up sufficiency test is around 1%. And generally, during low load periods, starting from November to January, it's relatively easier for Eim entities to pass flex ramp up test, because generally loads are lower and there is enough upward ramp capacity in the DA, but that usually puts a stress in the downward direction. Christina, can we go to the next slide? So this slide shows the flex ramp sufficiency test results for the downward direction. And then for the last 3 months, we have observed very few flex ramp failures for most of the balancing areas. For some that have the failures in the down direction, they usually range between 2 to 3%, and that's observed usually during the time in the afternoon when there is solar energy and it's relatively cheaper. And most of the thermal resources are actually operating close to their minimum range, and thereby having very limited downward capacity. I think that's all we have for these two tests. Christina, can we go to the next slide?
Sure.
Okay. And I will hand it to Guillermo and see.
Thank you, Rahul. Yes. Let me cover this last topic, and I think that would be all what we expected to have discussed during the first session of the market update. This last topic is just a follow-up. I think this is just the continuation of a discussion that we had a couple of years ago. You may recall that we had a very short and fast policy initiative related to what we call the Imbalance Conformance Limiter. That was a functionality that was put in place on February 27, 2019. In short, that logic that we have in the real-time market is to try to better assess the intervals in which we can let the markets be set for the administrative prices under the presence of a conformance. The prior logic that we have is that we only compare if the invisibility in the real-time market was smaller than the load conformance to trigger the price. The logic that we implemented was more sophisticated to ensure that it was more surgical and targeted to try to identify the cases in which the administrative price is set by the right conditions. Back at that time, we had a lot of discussions about not just the limiter, that is a logic for the pricing portion of the market, but also about the essence of having the imbalance conformance used across the market. And once we filed and we implemented this in our market, there was a commitment from the ISO that once we complete 2 years of having this functionality in place, we would start assessing the conditions to see if we have the necessary market design and improvements in place to be able to effectively disable or terminate that functionality in the market. The 2-year mark obviously is just a couple of weeks ago, actually just last week, to have this 2-year mark. And that is the reason we are having this discussion, because we want to give you an update on where we are standing on this specific item. In short, I think the summary is going to be that given where we are right now with the improvement that we stated that we needed to go through in order to disable the functionality, we are not expecting to disable that limiter around this time of the year once we have completed the 2-year mark. Next slide, please. And this is just to give you a sense of how the conformance has been coming across the different markets. This is more relevant to the real-time market. We have the HASP market, the FMM market, and the RTD market. In either of these markets, operators can dynamically adjust the load, what we have called historically the load bias or the load conformance, and in this initiative we call it as imbalance conformance because it's really about imbalance. It's not just an issue of load forecast accuracy. It's dealing with or throwing up the market with system conditions regarding the imbalance that is observed. And this first set of trends shows you the volume, the magnitude of conformance used in each of the markets across the last 4 years. The statistics are aggregated on a monthly basis. Each month has all the samples aggregated in this box whisker plot. The box stands for 80% of the sample. The tails of each bar is for the maximum and minimum level. The red dots are just the simple averages. And that just gives you a snapshot of what is the trend of using conformance across each of these months over the last 4 years. And you can see that the trend is basically there. It hasn't changed dramatically in one way or the other. In some cases, there may be indeed a slightly higher value used at some point in time, but in general, the trend is quite the same over these 4 years. Next slide, please, Tina. The one is effectively the same information, but it's organized on a daily profile. Each year is just a daily profile with maximum, minimum, the average values across the 24 hours. And you can see the trend is kind of consistent across the 4 years. Again, in the 2020, we may have seen actually higher levels, and maybe not surprising given the conditions that we deal with in the summer. And the story is that effectively the trend continues. We haven't seen a reduction or a change in behavior for the last 2-3 years. And that brings to the point of the discussion of what we committed to do in order to assess whether we could disable the limiter or not. Christina, next slide, please. When we discussed this limiter functionality, we indicated that in order for us to be at the point where we could disable the limiter, we wanted to go through different improvements and enhancements that we have identified or that we were expecting to develop. The first one was related to handling the renewable resources. Obviously, the accuracy of the renewable forecast is critical to ensure that operators can have a good handle of the real system. If there is issues with the forecast accuracy for renewable resources, that gap may have to be filled in by operators manually through the load conformance. At that time, we were already expecting, and I think by that time we have already implemented what we call the in-house persistency forecast for renewable resources. I think that was in April 2018. Since then, we have actually done a few enhancements to that logic. Indeed, we are expecting to have a couple more of enhancements to this functionality that is in-house in the next couple of months. And that naturally will reduce the gap created by the accuracy of the renewable forecast in the real-time market. That item is kind of done. The second item was related to the day-ahead enhancements. You have been all part of the discussions. That is still an ongoing discussion. It's not a complete policy. And one of the aspects that we are trying to address with these day-ahead market enhancements is the introduction of this new product that we call the Imbalance reserves. And the Imbalance reserves is no more than the gap that we can observe happening from the day-ahead towards the real time. If right now we don't have that market mechanism, naturally the operators will have to rely on other sort of tools to be able to account for that imbalance that realizes between the two markets. The other area that we identified that was needed to be in place is related to the performance of the flexible ramping product. I think we posted a performance report, I think it was 2018, regarding the limitations that we have found about the proper performance of the FRP feature. One item of those identified through this market performance report was actually implemented in November 2020, but the main component that is about ensuring that the FRP can be actually deliverable by the time it's awarded is still yet to come. That is part of the fall 2021 release, somewhere in October, November. It is then when we are going to have the full enhancement to address the limitations that we identify about the FRP. And the main limitation has been that the FRP product the logic of the FRP is such that we may procure FRP on resources that are behind constraints, behind transfers, and when they need to be deployed effectively, they get stranded behind the congestion and effectively they cannot be realized. So it's capability that is on paper and we cannot utilize, and therefore it renders not very useful for when we have to handle the uncertainty in the market. The last two, Imbalance Conformance tool and Ramping tool, these are tools for operators to have more information about the system conditions so that they can be better informed about the magnitude and extent of the conformance that they may need to have in the system. And the idea of these enhancements is to really provide more business intelligence to operators to know exactly where the system is, and that will reduce the need for them to make a subjective assessment of putting coarse amounts of imbalance in the system because they don't know exactly how much the gap may be. So this is one of the items that we discussed in this policy initiative, that one of the reasons to have the limiter was really about the coarseness that we have for the imbalance. They may go and just put imbalances in very discrete amounts of 100 megawatts. And having these tools is going to provide and equip them to have more specific information that can guide them to be more precise on the amount of conformance that they may have to use in the system. These are tools that some of them actually, one of them did make coming with this fall 2021 release. The other one is in place, but it's still subject to some improvements to the data processing. So these two are still in progress. And given this status of all these areas that we indicated that are need to be in place in order for us to be confident that we can disable the feature, we are not expecting to disable the feature at this time. That is the 2-year mark. And I wanted just to give you this update because we committed to have this follow-up once we reach the February 2021 mark. And here we are. Christina, let me see if we have any questions or comments.
Sure. So do we have anybody in the queue, Chris? Again, press #2 to raise your hand.
I currently have no callers in the question queue.
Okay. That's good. I think we are still somehow within the schedule. And I don't intend to go over the standard metrics that we have for the market update. They are there just for your convenience. If you have any questions, please at any time just let us know and we can follow up through either emails or an inquiry that you might have access to. Thank you for spending the time with us. And Christine, I think that's all what we have for this market update section. So I will pass it to you.
Sure, thank you. So we'll just give you one more opportunity if you have any questions regarding the market update. Again, press #2. We'll just give people time to enter the queue. Nobody in the queue, Chris?
Currently have no callers in the queue.
Okay, so I'm going to jump ahead, way ahead, so forgive me. And John, are you on? John and Brad? From the policy team?
I'm here. This is John.
Okay.
Brad's here. Brad's here.
Hello.
Can you hear us?
We can hear you. Yeah, thank you. Yes.
Okay.
Loud and clear.
Excellent. Okay, one sec. Okay. Thank you. This is John Gooden. My group is the Infrastructure and Regulatory Policy Team and the Market Infrastructure and Policy Group that Brad and I work in. So as we do on all of these meetings, I will share my team's initiatives and what we're working on, and then and more about kind of the scope and status and things like that, and then I'll turn it over to Brad to do the same, and then we can open up for any questions. So for today, what I wanted to do is just sort of make sure we cover all bases, and you know, kind of make the linkages between what we've been doing in the past and what we're doing here presently and in the future. And in the past, and as you all know, we've been working on some initiatives pretty vigorously here. The Hybrid Resource Initiative is something that we more recently wrapped up, and that had these elements that you see on the screen. Involved the aggregate capability constraint, the ACC, allowance for co-located co-located storage to deviate from dispatch under certain circumstances, and then there's some additional tools in that. And so the point here is that this set of Enhancements is going in the fall 2021 software release. So we're working on that now, but these have all been approved and are in the implementation phase now. As is the second major bullet here, our energy storage and distributed energy resources. That was phase 4. We had the default energy bid for storage, an end-of-hour state of charge parameter for storage devices, and a maximum daily runtime parameter for demand response. So again, just to give the big picture of these things, these two initiatives are underway and will be released in fall 2021. So let's move now to the initiatives we're continuing to work on. Again, those that are involved in our market, many are participating in this initiative, our Resource Advocacy Enhancements initiative. Again, we started this back in October 2018 and looking at ways that we can future-proof, if you will, the RA program, and in particular, our rules, tools, and systems here at the ISO, and our tariff requirements around resource adequacy, and how can we make those and keep those rules and tools relevant given the transforming grid. What you see here is that we've really been talking about this as a sort of a comprehensive package of different elements and refinements we're making, but it's broken into a couple of phases so that it's more manageable and taking on some of the things that are more urgent. What you see in the phase 1 implementation, and that's our planned outage process, a minimum state of charge requirement, and then a backstop capacity procurement authority to cure any local energy insufficiencies we find in that annual showing process. Phase 2 is a portfolio assessment, a monthly assessment, making sure that the shown RA resources actually meet all of our needs from capacity, energy, ramping, uncertainty, things like that. Transitioning to a different capacity counting methodology called UCAP, or Unforced Capacity Counting. Minimum system RA requirement, setting a minimum requirement that accounts for ensuring that we can cover our operating reserves and our forecast error. And the forced outages would obviously be embedded in the UCAP number for resources. Our import reforms, further enhancements to our planned outage process, refinements to must-offer obligations, flexible RA changes, refinements that have been somewhat on hold, but we'll be getting to those right later this year, and then, again, some backstop capacity procurement authority to cure any of the deficiencies we find in the portfolio assessment. So that's the whole panoply of elements. It's massive, we know, and it's divvied up into these two phases as shown here. Next slide. So the timing and status on these is that those phase 1 items, we posted that final proposal on February 17th. The intent is to take these to our board at the March meeting, which I think is around March 24th, 25th. So that's coming right up. We're preparing for that. And a couple of those elements in that phase 1, the POSO and the minimum state of charge, we're trying to get those implemented for our summer 2021 readiness efforts. So in the July timeframe, and then the CPM authority as well. We'll try to get that stood up and ready as soon as possible for 2022. Phase 2 items. Again, you saw there was a whole list of items. We published a 6th revised draft proposal on December 17th. We plan to have a 7th revised out in April, and the intent is to bring this to the board in September, and our RA imports piece in that phase 2 likely in November. So we see how this all shakes out and how things play out in these next couple of revisions. But the intent is to try to get those phase 2 items to and through the board this year, whether it be starting in September and possibly November and even December. So we'll just see how that rolls out. And then finally, there is no EIM governing body role, given that RA is a ISO BAA specific policy. Okay, thank you, Christina. Okay, so kind of casting into the future here, initiatives that we are about to launch on the cusp is an energy storage enhancement initiative. Again, this initiative is to continue to look at, refine how we manage and optimize storage resources, and ultimately how we settle those resources. So folks are aware that we are putting in place the minimum stated charge requirement. That is not the most elegant solution. We all understand that and realize it. And it needs definitely more refinement. And so we're committed to do that through this initiative and again, just find ways, market-based mechanisms to replace that MSOC and sort of more brute force, sort of exceptional dispatches and things like that to manage storage. We really want to refine the market and market processes to better manage these resources. So that's really the scope and intent. We are having a lot of discussions internally about this policy and kind of sort of considering the path forward in an issue paper that we'll be releasing in April. And the target is fall 2022 implementation. So a little time, obviously, to work on this, but this is a very important item, we know, to a number of folks and stakeholders. Next slide. Thank you. Okay, another initiative that we are working on, and it has kind of moved a bit, is we've been working on the MIC, or the maximum import capability enhancements. These are the maximum capability that we can allow for RA imports that are simultaneously feasible. We are going to be working on, as part of that initiative, and in conjunction with that initiative, because they're related, is monthly allocation of available import capability. This issue really emerged out of the summer readiness with discussions for those that have followed on the export priorities and wheel-throughs and how we preserve or maintain some level of priority for wheel-throughs relative to RE imports. It's a very tricky and challenging policy, but we're going to be working on this year is to develop enhancements on the maximum import allocation process and develop a process for entities to procure import capability and transmission on like a forward basis, like a monthly basis, so that they could secure transmission for imports. Again, not a lot of meat on the bones right now, but stay tuned. This is something we're going to be addressing expeditiously here this year. EIM governing body role, again, to be determined. We'll have to think about that because it does impact, obviously, external entities, and we'll begin this initiative here in the second quarter. I think that's my last slide before we turn it over to Brad. But I will say just one other point or initiative that's not on here, but it's going to start later this year, so just give you a heads up, is we have a hybrid evolution initiative. We're going to be talking about further refinements to our hybrid model, hybrid integration, and again, I think all of you that are engaged in these issues know that just like storage, hybrids have some similar and challenging integration issues that we want to continue to refine, and we will be doing that, but that's going to be a little later this year. So we haven't forgotten about that. We're just trying to sequence and manage workload, and particularly given all the summer readiness issues that have sort of usurped a lot of the staff resource and time. So Christina, next slide. I think we go Brad.
Yeah, I think, why don't we go ahead and just pause here and see if there are any questions about the updates you've provided so far, John. So again, press pound 2 if you have a question.
Yeah, you bet.
And Chris, let me know if anybody enters the queue, please.
All right, I currently have no callers in the question queue.
Okay, Brad, take it away.
Thank you, John.
Okay, sorry, just having unmuting issues. Yeah. Okay. So, the first jam-packed slide I have here is the market enhancements for summer 2021 readiness. I'm sure most of you are familiar with this. We've been working seriously to develop market rule changes in response to last summer events that we can implement for this coming summer 2021. And as I'll get into in the following slides, this has spawned a couple other initiatives. Actually, John just mentioned one, the initiative to look at a process to release transmission on a forward basis that's related to the load and exports and wheeling topic that we're talking about as part of this summer readiness. The Eim governing body role, the changes to the resource sufficiency evaluation, and then interchange modeling enhancement, or other words, the requirement to make auto mirroring as system resources mandatory is under their primary role, and we'll be presenting that to them at their meeting next week. And then the load, export, and wheeling priorities topic, and then the pricing enhancement to price energy at the bid cap under certain conditions is under their advisory role. And then there's another set of tariff changes having to do with reliability, demand response, resource dispatch, which they don't have a role in. That is applicable to the reliability demand response that's CAISO BAA specific. We posted our draft final proposal and draft tariff language last February 18th, and then we recently received comments on our draft final proposal, and then we're going to have an MSC call on March 8th, and like I said, we're going to be presenting the resource sufficiency evaluation, the interchange modeling enhancements, and then the quote-unquote scarcity pricing enhancements next week at their board meeting on March 10th. Now, we've deferred the load, export, wheeling priorities topic, and that's why we didn't talk about that tariff language on the recent tariff call. We'll be coming out with a revision to that proposal sometime soon, potentially. We're still working. Honestly, we're still working through the changes we want to propose. Hopefully, we could get that out next week. Probably be later next week. We're also going to propose a couple other changes. We're going to propose a change to the in response to comments, we're going to propose a change to not allocate any of the cost of import make-all payments to EAM transfers out, and then we'll likely propose changes related to the resources, not RA resources, backing high priority exports or backing high priority exports. So the plan is to bring all of the changes to the EIM governing body and then bring them to the board meeting in March, and then the load, export, and wheeling priorities, most likely what we'll do is schedule special EM governing body and ISO board meetings in April to go over those topics. Maybe I should just stop right there for questions. I know this might be complicated.
Yeah, good idea. So, Chris, do we have anybody in the queue?
Yeah, we do have one caller who joined the queue. All right, caller, your line is now unmuted.
Hi, Brad. Dan Williams, Customized Energy Solutions. So just on that last point then, the proposal not allocate import make-whole payments to the EIM transfers out and the non-RA resources, that change, does that mean that you'd be delaying those two pieces from the board or the governing body and the board approving them in March, or can you just kind of move forward with those getting approved in March since they're relatively minimal changes and
those won't be topics for next week's EIM governing body meeting, and we'll move forward with those in March. You know, we look at those as relatively minor changes, and you know they're the kind of changes that typically we would just make in response to comments in the board memo, and then clean up later in a final proposal so they're documented. I think you know we'll get them out in the draft final proposal prior to the board meeting. We might not have time to get comments on them, but you know they're already changes in response to comments, so we just look at those as you know making the final little tweak to those items. And then I should note, you know, the MSC opinion for March 8th won't include that load export wheeling topic, but similarly, they'll put out a separate opinion, and then we'll talk about that. You know, they'll put out their opinion, then we'll bring that topic to the EIM governing body and our board in April.
Great. Yeah, that makes sense. I mean, I can definitely see where the NSC opinion and the comments already address those kind of two more minor points. So happy to see those still getting moving forward so it can help you all stay on track. So thanks.
Sure.
Any other questions, Chris?
I currently have no more callers in the question queue.
Okay. And then, sorry, my thing is covering up the title. You know, a lot of the comments on our summer readiness proposal were that we need to continue to develop further enhancements to the EIM resource sufficiency evaluation, and you know, those also include you know, that we really haven't talked much about yet in the stakeholder process, examining modifications to the consequences for resource sufficiency evaluation failure. So, you know, in response to that, we're planning to begin a follow-up initiative to look at further changes, and we plan for that start sometime in Q2 once we've wrapped up these other summer changes, and that's as with the existing resource sufficiency evaluation enhancement, that's under the EIM governing body's primary approval rule. Okay. Yeah, next slide. Yeah, and this Western EIM sub-entity scheduling coordinator role is looking at a way to, or the methodology for allowing multiple scheduling coordinators in other than the EIM entity to directly schedule and settle non-participating loads and resources. That's under the EIM governing body's primary approval role. we're planning a draft final proposal and tariff language coming out next couple weeks or so with a stakeholder call, and then our plan still is to bring that to the May Eim governing body and ISO board meetings. Next slide, please. Market enhancements. I won't go over all this. I think everyone knows what this is about. In any case, we're planning on restarting this in the second quarter. And I should caveat all these start dates. Obviously we have a lot going on now and a lot of balls in the air and things change, and so I would characterize these start dates as aspirational current plans, and they may well change, may set in stone. This, I think this may be optimistic to start in the second quarter is what I'm getting at it, but we do plan to start this up mid-year as soon as we get some bandwidth and get these other things wrapped up. Yeah, the extended day-ahead market, and I won't go over all this stuff. We've been over this about a million times. This is restarting an initiative in fourth quarter, but really that continuation of the resource sufficiency evaluation is serving as efforts towards the extended day-ahead market, because the resource sufficiency evaluation is in bundle one, and agreeing on an equitable resource sufficiency evaluation for the EIM is core to agreeing on a resource sufficiency evaluation for the extended day-ahead market. So I don't really look at it as we're putting the extended day-ahead market on hold until the fourth quarter. We're just focusing on this resource sufficiency evaluation first, which is core to the extended day-ahead market. Next slide. Then the scarcity pricing. This is an initiative that we had talked about for a long time, and then last summer's market conditions really brought it to light that this is a pretty big gap in the ISO market, not having the most robust scarcity pricing provisions we could, and so that this initiative is going to address that and develop scarcity pricing provisions. As part of this initiative, I think the first step we're going to do is map out a roadmap for scarcity pricing. True scarcity pricing, like the other ISOs do, likely requires reoptimization of ancillary services in real time, and may require creation of a different reserve product. And that's not something we're going to design this year and implement next fall. That would likely be a multi-year thing, but there are likely interim steps we can take along the way. So the first thing we want to do is focus on that, come up with that plan. Then also, if appropriate, we'll reconsider the currently developed system market power mitigation design. Like we've said, we continue to monitor to see to look for evidence that suppliers are exerting market power at a system level. It hasn't shown up to date. And then also we're open to looking at our currently proposed system market power mitigation design. So we would address that also as part, or potentially address that as part of this initiative. And this one, we are also planning to start off relatively soon once we wrap up the summer enhancement stuff. Next slide. Yeah, the dispatch enhancements, this is various enhancements to improve renewable resource management, how they work in the market, things like renewable resource ramp rates. I believe we were also going to look at whether we need decremental market power provisions and you know, various topics related to the dispatch and management of renewable resources in the market. This is a change from our, and I should say a lot of these schedules are changes from the last annual plan we put out at the beginning of the year. We're pushing this off somewhat to start later in this year. I think it was originally scheduled to start mid-year, but again, our priorities continue to evolve. Next slide.
I think that's it.
This might be. It might be it. Yeah. And any questions?
So again, if you have a question, press pound 2. Give it some time.
All right, and I currently have no callers in the question queue.
Okay.
Okay.
Thank you so much, Brett. Thanks, John. All right, Adrian, are you on?
I'm here, Christina.
Hi.
All right. Good afternoon, everyone. This is Adrian Kiosa, manager in the Program Management Office of California ISO, and I'm here to provide updates on the release plans we have. My presentation is very similar to what you see in our release user group. We had one last week, and since the next one fell next week on a Tuesday, very close to this update, we canceled that. So if any one of you is interested in that RUG, our next RUG event will be on March 23rd. That's the next update you'll get in our releases. But we have other things. I think we have a market sim starting next Monday, so we'll have opportunities to have checkpoints and discuss with you the latest on our plans for releases. Okay, with that, thank you, Christina. Page or slide number 96, we have our training programs, and I don't have the benefit of someone from our customer service. Usually Cindy Hinman is here to provide this update, but I see that they have listed some general classes that we plan to conduct in June. And I know there's some immediate training that will go associated with projects. For example, today I think it was one on RT settlements, but we can get to that when we get to each individual project. So with that, let's move on to the next slide, Christina. So 97 and 98 slides are summaries, list of our releases, the batches of projects we have in each release. So in 2021, we have multiple batches, right? As you know, a typical year, we only have a spring release dedicated to EIM integrations and a fall release dedicated to major policy and, projects that require market simulation. We have some independence, but we're trying to keep it at a minimum. This year, as we've discussed in prior RUGs, we have a release associated this summer just because it is so important for us to get ready for this summer of 2021. So this is the list of projects. I think we have individual slides for it. I think what I missed in this list, let's go to the prior one, Christina. Sorry. What I missed on this list, I should have added in the independent, I should have added this ADS additional features. As you know, we implemented the ADS replacement project last year, but we have some additional features that were requested and agreed in that process that we postponed for this year. I think we're ramping up for market simulation this month, and we don't have yet a final target date for implementation of that project, but I should add it here for reference under the independent project just because I know there's interest in those additional features coming with ADS. Okay, going to the next list of projects, the fall of 2021 and the spring of 2022. Again, the fall of 2021, we have slides, and I have a matrix when we get to the fall 2021 that goes into the details and the timeline that we have associated with this release of a top-down planning and timeline. In the 2022, we have 5 EIM entities that we plan to bring on board for energy imbalance market. So if you don't mind, Christina, would you go back to the prior slide because I forgot, it just occurred to me with the CIMs. All right, so on the spring of 2021, we have 4 EIM entities in the spring, the bank, WAPA, TID, PNM, and LADWP. As you may remember, we also have the Northwestern, an entity, but they postponed the integration until June for better readiness of that integration. So I should have also added them as an independent just because they're coming in sometimes in the June timeline, and anyone interested should know that if they're wondering why the and Northwestern Energy is missing from our list is because we postponed the implementation in June of 2021. Thank you. Christina, you can go to the next slide and the following one. All right. The Gantt chart representation of our release plans. I hope you are used to seeing this plan, this Gantt chart. At the very top, you have the timeline from now until the end of the year. And the upper section is the presence of projects in market simulation in map stage environment. The lower part is the target dates for production deployment. So hopefully this is a kind of a good summary, like a visual representation of our plans for interacting with you in market simulation and deploying projects in production. Okay, let's provide updates on the spring. Here it is. That's my prior note. As you will note here, Northwestern Energy is missing from the spring of 2021. As I said, they're moving to June. News on this on the EIM integration activities that all those 4 EIM entities have certified their readiness and filed with FERC for that readiness certification. So at this point, it's us completing the parallel operations exercises, and we'll have bank and TID starting on March 25th, and then PNM and LADWP will start on April 1st. We have several associated projects that are in support of those EIM integrations. So we have EIM Enhancements 2021 Phase 1. Let's go to the next slide, Christina. Again, the first 2 slides represent the impact and the scope that we have in this project. And on the timeline part, so we plan to deliver training on March 8th, and I think our aim was for March 31st. We're still aiming for that date, but the functionality included for this Phase 1, immediate functionality needed under this EIM Enhancement 2021 Phase 1, was principally directed at Northwestern. With them moving out, we still plan to provide this functionality by April, but there's a chance that this will slip a little bit just because it's not that urgent anymore, and we need to focus our efforts on being ready for the other EIM entities. So that's just a kind of a heads up to you that in case you're interested, and if you have any issues or questions, please don't hesitate to ask or send us a CD ticket and we'll respond. Base schedule submission deadline, Phase 1, the main feature is ability to bid under PMN, and this it's on a fast-track timeline. I think the scope that you see here and in the next slide is detailing the entire scope of base schedule submission deadline projects, which has a phase 1 due by April 1st and a phase 2 that will be completed in the fall because of the amount of scope we have under this project. I think those slides kind of separate between phase 1 and phase 2. Right. So the same timeline, external training in March, and ending up with March 31st as a production deployment ahead of that April 1st. A third project that also, so Eim Enhancements, base schedule submission deadline, and our real-time settlements review, all three projects are split phase 1 for spring, before April 1st, and then a phase 2 that goes in the fall of 2021. So I think the project goes well. It looks like I mentioned earlier, we can put a check mark on this external training. It was conducted today. And, we have a good confidence we can make it by April 1st. Third quarter 831. I think we may still have Guillermo with us, and I think he came in the last slide and gave you a lot of updates and explanation, and I hope that one brought a lot of clarity. As you know, earlier this year we had that petition for a waiver to extend the date of FERC 31 in the summer. Then given the conditions we saw on the gas market, we changed our mind and we draw that petition. That means that we plan to comply with the FERC quarter 831 by the deadline, which is March 21. And I know many of you are interested when it's going to be deployed. We're monitoring closely. I think we plan to conduct some additional testing on this one. It looks like implementation will happen by the 18th of March. I think that's what we have a tentative date for that. For this implementation, we're trying to make it even earlier than that, and if we can, and we have the confidence and the firmness of that earlier date, we'll send a market notice as soon as we realize that. So that's the best I can do today. I know some of you may have questions regarding the timing of this. I know there are some questions at the last track, but this is our plan so far. Tentative target date March 18th. Maybe this is a good point for me to stop and ask if there are any questions.
It looks like we have one question in the queue, and then again, just a reminder to press pound 2 to enter the call queue. So go ahead, Chris.
All right, going on to a caller in queue. All right, caller, your line is now unmuted.
Hi, Adrian. This is Chun Yu from PG&E. I do have a question for Guillermo on the understand the notification when the bid cap raised to $2,000, and how does CAISO notify market participants, the SE?
Hi, this is Guillermo. I'm not sure to follow the question. Are you asking about what mechanism we are going to use to communicate to participants that their bid is accepted?
Yeah. So when the bid, when the bid is over $1,000 and accepted, and then CAISO will notify the SC, right?
This is going through the standard system that we have, that is Cyber. That is the application we use for participants to send the bid. There is a process that we call cost verification. And that is going to depend on what the default energy bid estimate is, and see if that exceeds the $1,000. And in that case, your bid is going to be accepted. But you will be able to know by the time you are submitting the bid, basically.
Okay. So, but once the come to March 18, right? When the bid cap raised to $2,000, and do you still have the same mechanism that to have a menu adjustment submission, or is that if we bid over $1,000 and then if CAISO accept that, and how does CAISO notify the SC?
Yeah, if it is going through the automated process, effectively you're going to be able to see through the system whether your bid is accepted or not. There may be some cases in which that is still kind of part of the CCDEVI plus 831 because there is common functionality there. In case you will have to submit a manual request, effectively you have to do it by 8 o'clock, and then we will have to let you know whether the request was approved or rejected. And that should happen in the next few minutes after you submit a request by 8 in the morning.
Say it again, it should happen in the March 18?
No, let me step back and see if I can give you a better picture. So currently, with the implementation of CCDEVI, participants are able to use two ways to request an adjustment, and that is for commitment costs, including minimum load cost, startup cost, or default energy bids. If the participant uses the automated tool that is through the cyber application, they know exactly whether the request for adjustment is approved or not by the time they are making the process. It's automated. It's just through the application. In addition to that, there may be conditions in which the participant may request a manual process because the adjusted and automated process may be not giving them enough what they believe is going to be the cost. In that case, the participant has to rely on a process that is manual. Effectively, they have to submit a request by 8 o'clock of the trading day for real time of next day ahead market. And once the request is submitted by 8 in the morning, we will let the participant know in the next few minutes whether that request is approved or not. That is effectively the CCDEVI process that is in place. Now, on top of that, we seek relief for being able to use the after-the-fact cost recovery for bids above $1,000. Between the time CCDEVI was implemented, that is February 16, until the day we go with the full implementation of 831 on no later than March 18, participants can only come through a manual request if they have bids that are above $1,000. And that means they have to make the submission by 8 o'clock, similar to the CCDEVI process. And accordingly, we're going to let them know if that request is processed or not. After March 18, when we have the $2,000 bid cap in place, participants can go and put a bid above $1,000. That bid has to be cost verified, and that is an automated process inside in the cyber application, the same application you currently use to submit bids, in which we use as a reference the default energy bid. The participants can come and make an automated adjustment for that. If it is processed and basically approved through the system, participants will know by the time they are making the submission whether that bid is accepted or not. Still, even after March 18, participants still have the ability to request after-the-fact cost recovery even for bids that are above $2,000, the bid cap. And they will have to continue to rely on the manual process to submit a request by 8 o'clock in the morning. These are really the different stages and processes that you can use. Does that answer your question?
Yeah, I think so. I guess you did explain it well. I just that when CAISO approved that, you say when market participants submit that by 8 o'clock in the next few minutes, you should know it's being approved or not. is that through CD as well, or what is the mechanism to let the SP know?
Yes, it's through the same request process that you use. That is CD, yes.
Okay, and I do have one additional question, sorry. Also, we saw the seeking for the cost recovery over $1,000. Also, in the tariff, it's also saying we can have 60 days after to seek for the recovery. Is this the so we saw the notice notified at 8 o'clock. So is that this is the additional, right? Additional way if we do not submit it by 8 o'clock, we have actually 60 days to submit the all the material for cost justification. Is that correct?
I would have to check if it is 30 days or 60 days, but what you're referring is to the catch-all last provision that we have, that if for some reason the manual request was rejected or you could not put the information on time and so on, regardless, there is a provision that allowed any participant to seek fuel cost recovery, and I believe that is under that is section 30.11 or something like that, and for which they can basically file a request for the fuel cost recovery. And yes, there is a window of time for which you have to make that. Right now I don't recall, and I have to check whether it's 30 or 60 days.
Okay, thank you. Thank you very much.
You're welcome. Yeah.
We have one more in the queue, Chris?
Yes, we do. Moving on to that caller. All right, caller, your line is now unmuted.
Hi, Josh Arnold, PG&E. Just a follow-up on Chun-Yu's last question. I think this is more not a specific participant question, but a market question. If in the event a market participant under the proposal under FERC 831 is selected for bid in excess of $1,000, cost verified bid of over $1,000, and triggers a new $2,000 price cap, how will the market be notified of that situation? Not necessarily the participant who received their bid, who was awarded the bid, that comes through CYPR. How will the market be notified? I think that's the clarification that we also would like.
Yeah, that's a very interesting and subtle question. Let me try to answer in two parts. The first one is that between the time we implement the FERC 831, no later than March 18, to the time we implement the market enhancements for this initiative that is called bidding parameters and import bid verification. In that period, after March 18 through June or so, the bid cap is going to be set to $1,000 all the time.
Okay.
It's not going to be in and out based on the bid. It's all the time. That is the simple version, the original version of FERC 831. It's going to be more sophisticated based on the logic that we define in the policy initiative for import bid verification, that may be 1,000 or 2,000 depending on the bid is verified or not. That is going to come way in the summer.
Okay, so when it does trigger later in the summer then, how will the market be notified that this event has occurred? Because there's a transparency question there for participants to know that we have reached a situation where bids above $1,000 have been cost verified and accepted. So there's some concerns there about transparency. How will we be notified of that? Will that be a market notice? Will that be an OASIS report?
Yeah, that's a great question. Let me take this back. I think we still have time to figure out the details to make sure that we provide the transparency that is needed rightfully. So let me take that back, and I will make sure that we have an answer and a process for that.
Great. Thank you very much. That's very helpful. Very clear.
Thank you.
Any other questions, Chris?
All right, I currently have no more callers in the question queue.
All right. Chin-Yu, Josh, and Guillermo, thank you very much for that conversation. All right, for moving to the summer, right? Summer 21 readiness. I think you heard from, we're still in the policy. I think you heard from Brad earlier where we are with that. and we're trying to keep as close as possible with our requirements and, providing as much information to you as early as possible. I think one note in blue here that I mentioned it at the last release to the group is that due to the scope that we have in the summer readiness, and this year will be kind of an exception year where we plan to post 2 GRDTs, one in the summer and one in the fall. So just heads up for those that are interested on that part. Okay, let's move on. Right. So summer readiness, I think that's what we have. This is the timeline that we have. We posted a draft BRS, obviously with information we gather from the proposal in the policy track, and then we plan to provide you with a version 1 of the BRS by March 15. I think that's our target to complete that BRS and define the scope of this project, since we have to deploy it by the summer. The rest is other target dates that you see for our summer readiness, which is obviously a compressed timeline, and we're still discussing internally, and we're just going to seek feedback from you regarding the appropriateness of this timeline. All right. Also, a policy that I think you heard earlier from John. I think we're going to the BOG towards the end of this month to get approval on it. Let's go to the next slide. Okay, to the timeline. I mean, at this point is, the system impacted, the CIRA, the OMS, and the, I think, settlements. And then boards, it's again towards the end of the month. We have a version 1.0 for the plan outage substitution posted on 26. Operationalizing storage or mini state of charge, I think it's coming on March 15. And then I think we have a second phase that comes in the fall release, right, as we heard from John earlier in this update. So as you can see, we also have compressed timeline regarding the posting of the technical specification and the configuration guides and the tariff filing. Again, the target is June 1st, but we are still discussing internally. We're going to make it a more focused conversation with all the market participants if June 1st is a feasible timeline or not. We already heard some indication that this might be too tight, and as soon as we have more information, feedback, and a firmer schedule on our side, we'll just, probably by the next ROD on the 23rd, we'll have a much better, much more firmer timeline for this implementation. FERC Order 831, this is the remaining pricing parameters, import bidding, screening, and validation. This one, as you saw on our filing, it's coming on June 15. So we're working towards that. I think it's everything is all in good order. I think I'm mentioning here all what happened with the filing, the fact that we reverted back and we plan to deploy this, to comply earlier by March 21st. And now it's March 18, the target when we plan that implementation of compliance, and June 15 is the implementation date for this pricing parameters.
I think that's it for summer release.
Yes.
So do we have any questions related to the summer release plan? Again, press pound 2 to raise your hand.
All right, I do have one caller in the queue. All right, caller, your line is now unmuted.
Hi, Asian. This is Chanyu again. I do have I thought what I heard about the RA track 1 in the policy call sounds like it's targeting in July. Can CAISO clarify that? Maybe next time when you have the information.
Yeah, I think so. Yeah, I think we are discussing with our policy colleagues, and we are just evaluating the efforts and as I said, the feedback we get from market participants. And at this point, we're looking to see if June 1st is. That's why I made that point proactively, just because there's a lot of conversations that could end up with our target being July 1st rather than June 1st.
Thank you.
Any other questions, Chris?
All right, next, I only have no more callers in the question queue list.
Hey, independent project. So exciting news. I think we worked with many of you recently on being ready for those CRI enhancements, and we have closed all the severe tickets, severe city tickets that we have received, or help market participants in overcoming the questions they had. And our quality reviewer approved the project early this afternoon, and we are in the middle of deployment, I think between 2 and 5, based on the market notice you've seen earlier from us. So by 5 o'clock, this will be in production, and you can start using it. Okay, Intersite multi-stage. This is, one of those late comers in the Eim Enhancements 2020 that took us a little bit of time to work it with our vendor and our internal development to complete this additional feature. And I think we're saying March 8th. I think it just slipped by one day. March 9th, I think, will be the date when we plan to activate this in production. Aliso Canyon Phase 5, also a project that was considering starting in 2020. We have, all the code, everything is deployed in our testing environments, and we're working towards testing the entire scope of this project. I think we heard the earlier request from you coming regarding an analysis from the testing results we have. We're working towards that one too, and so far, I think our plan, given all the other things that we have on the release planning, is to complete this by end of April. So I don't have an exact date. As soon as we get comfortable with the testing results, we see in our testing activities, then we can be more final in the terms of target for the target date of this deployment. VOM, I think this is a change from the last project we've seen, and variable operation and maintenance cost review. I think we indicated that as a full release. It is not a full release. I think our mandate is to complete this by the end of the year. At the very end, I think it will become effective on January 1st of 2022. But we plan to complete all the development and readiness, together with a fall cycle. At this point, we just don't want to create confusion. Just want to make sure that you understand this project has a mandate to be activated by 1/1/2022. So that's why we're going to name it Independent Project, and we'll communicate the progress and the timeline of it as we move on. Yeah, please, I think we have slight updates on this slide. If you have any questions, I think we have a BRS that was posted in November of last year. So we also synced up a little bit those slides with the content of that BRS. So if you're interested in this project, make sure to review those 2 slides, and then let us know if you have any questions.
I think that's it for the independent release. So do we have any questions?
We currently have no callers in the question list.
Okay. The full release. The full release is just a little lower because of the VOM, right? The line smaller. I think what you see on this one, for the hybrid resources 2 and Eim enhancements, we still have a BRS in the future, 317 is the target date, and we are quite comfortable with that, which is a lot lower than, a lot earlier than April 1st, our, tentative deadline for the BRSs. We have also determined that we have no integration impacts for those projects that have NA. And then for the remaining one, I think we will have integration, or it's still TBD, but we plan by the next RUC to provide a full list of all the integrations that we'll need for those projects. I think we have completed that assessment. We are in the process of working towards those technical specifications, and we have good hopes that we can deliver those technical specifications a lot earlier than that, target date of end of May. So that's where we stand. Hopefully that's good news to you, because you can start development on those integration earlier. Configuration guides, I still need to talk to Jeremy on the settlements part to get more specific dates when he plans to be done with the configuration guides. And we probably you'll get also updates from his regular settlements group updates that he conducts regularly. So the next slide that we have on this deck are scope items. I don't put timeline because we are still developing those timelines. Christina, if you go back to the prior slide. And I'm not going to read it. I think we're running out of time regarding our target timeline for this market planning and performance forum. And I think those details are extracted from either our impact assessments or from the BRS that we already published. So I don't see much value going through those just for the scope that you can find in much better documented, published documents. So with that, probably I want to stop here and ask if there. I'm sorry. One last item. I think the spring of 2022, we have 5 EIM entities, and we have a standard timeline for that implementation. And at this point, I'm going to stop and ask if you have any questions regarding the fall release or the spring of 2022 for the EIM integrations.
So again, press pound 2 to raise your hand.
All right, and I currently have no callers on the queue list.
All right. Well, right on time, I guess. Thank you so much for participating in this update. At any time, send us a ticket. If you have any questions, reach out to us, the Market Sim inbox. As I said, we'll start a new round of Market Sim in next week. So thank you again. Be safe. Thank you, Adrian. Appreciate the update.
Okay, so that was the last item on the agenda. These are just ways that you can participate in the release planning efforts. So I will go ahead and just, our next meeting, our next NTTF is scheduled on June 2nd. We are going to try to make sure that these are scheduled in the morning, just so that everybody can participate. So if you have any topic suggestions, you can either submit those through Citi, or you can also email the IOSA Stakeholder Affairs Group, and we will make sure that we pass those suggestions along to the subject matter experts. So are there any other questions before we conclude today? Again, press pound 2.
I currently have no callers on the question queue list.
Okay. Well, thank you all for participating. Greatly appreciate it. Be safe, and we'll talk to you soon. Thanks for your help today, Chris.
That concludes our conference. Thank you for using Event Services. You may now disconnect.